This video goes over the different computations involved in budgeting. So the first one talks about a flexible budget. So we have an assembly department that has budgeted direct labor costs of $123,500, property tax of $14,700 for 6,500 hours of production. So the first thing we want to do is figure out, well, what is that direct labor rate? So we take the budgeted $123,500, divide that by the budgeted $6,500, 6,500 hours, and that'll give us $19 per hour. So that's their labor rate. Then we're going to take that labor rate and multiply by the actual hours of production. So the 7,200 hours of production at the $19 per hour gives us direct labor of 136,800. Now the property tax is fixed. It doesn't change depending, it doesn't matter if they had 7,000 or 6,000 or 8,000 direct labor hours. Property taxes will remain constant. So we'll add those together to get to our total budget for that assembly department. Then our production budget, we want to focus on our inventory. So basically, we are going to factor in our desired inventory, what do we need to meet our sales, and then subtract out what we currently have on hand. So Harbor projected their sales of 252,000 personal journals for the year. Their estimated beginning inventory is 13,700, and their desired ending inventory is 19,700. So what is their budgeted production in units? So obviously they got to cover their sales, and then you have to add their desired ending inventory. So in total, they want to produce 271,700 units. They currently have 13,700, so we can subtract those out. So they need to actually produce the difference, the 258,000 units. Then we're going to use that to figure out, well, what's our direct materials? So again, they're going to make 258,000 journals, and then over in the problem it tells us that there's 5 square yards of paper required for each journal. So then the journals we need to make times the 5 square yards gives us 1,290,000 yards that we need. We want to have 17,000 square yards in our ending inventory. So again, that's not necessarily the production, but the material desired, our total material desired. And then what do we have on hand right now? We have 25,100 square yards. Again, it tells us in the problem, so we can subtract that out. So then we're going to need to purchase 1,281,900 square yards at 60 cents per yard. So then our price, is that $769,140. Then what about our labor? So again, same thing. We still want to make the 250,000 units of journals. It takes 6 minutes to make a journal. So then if we take the number of journals we need to make times our 6 minutes, that'll give us 1,548,000 minutes. Obviously, we don't pay our direct labor people by the minute. So divide that by 60 minutes to get to the hours. So 25,800 hours. And then it tells us that the assembly labor costs are $16.50 per hour. So then if we take the 25,800 hours times the $16.50, we will get the $425,700. Then our last thing is putting together our cost of goods sold budget. So some of these are tying back to information that we computed above. So those are kind of referenced there to the left. But in the one column, we're going to have our finished goods inventory at the beginning of the year, which if we read this problem, it gives it to us. So it says, assume that the estimated inventories on January 1st are $41,100 for the finished goods inventory. So that is that number. And then $35,700 for work in process. So that's that number. So that's where they start. Then these numbers pull up from above. So we had our direct materials beginning inventory. So if we go up to this up here, our beginning inventory is right. So these are in yards, though not dollars. So the beginning inventory is in yards, $25,100, or sorry, 100 yards. Then when we go down, we see that that's what that's calculated, 25,100 yards at the 60 cents, puts it into dollars. Then what we purchased, again, from up above, the 769,140, so that's what we calculated there. That goes into our direct materials purchased. So then that is just the total of those added together. Our beginning inventory plus we purchased is what we had available to use for our direct materials. And then we subtract out our ending inventory. So again, looking at my formula, it's the 17,000 units at 60 cents. If you go back up to this problem, that's what they told us. We wanted to have 17,000 square feet in our ending inventory. And again, multiply that times the 60 cents to put it into dollars. So then we subtract that out, and that is our cost of our direct materials placed into production. And then our direct labor costs come from directly above what we calculated, the $425,700. That's what we used direct labor to produce these this product. And then our factory overhead, look back over here at the problem. It tells us the factory overhead was budgeted at $197,200. So that's given to us. Then we'll add our direct materials, our direct labor, and our factory overhead to get to our total manufacturing cost. And then we're going to add that to our beginning inventory, right? Yep. So this is our total manufacturing costs. Add that to the 35,700, and we get our work in process during the period. And then we subtract out our ending work in process, which tells us over here it is $50,900. So we'll subtract that out. And then that's going to give us our cost of goods manufactured. And that cost of goods manufactured, and I move it over to the next column because this represents going into our finished goods inventory. So then it goes into our finished goods inventory. We add those two together to get to the cost of the finished goods that are available for sale. And then we subtract out our ending inventory, which again gives it to us in the problem, that 49,800. So that is our cost of goods sold. Now, I suppose you probably could really do this like in 3 columns and scooch all that direct materials over to the left. If you like that better, you'd have a direct material column, a work in process column, and then a finished goods column. Then it would all be kind of a little more nicely organized, but hopefully that makes sense. Then the final thing is just the cash receipt side of the cash budget. The whole cash budget not only does the cash receipts, but does the cash payment, but they don't give us an example in these practical exercises. So all it does is it maps out the cash receipts. So it tells us that 25% of the sales are collected in the month of the sale. 75% of the sales are collected the month following. So if we have budgeted sales of 246,000 for September, 284,000 for October, what do we think the cash receipts will be for October? So we'll have 75% of the month prior, which is September. So if you look at my formula there, I've got 75% times the $246,000 to get to that 184,500. Then 25% of October, which again, October is the 284,000. So again, looking at my formula, I got 0.25 times the 284,000, and that gives us 71,000. And then you add those two together for your total receipts. Now, your total payments can go that same way if you're buying inventory or merchandise. A lot of times, so much of that is paid in the current month. The rest goes out to the next month. Most of your selling and general and administrative expenses are paid in the month that they are incurred. But then you could also have like quarterly interest payments, capital expenditures, other things that could go into that month as well. And then you'll look at it to say, do I have excess cash or am I in need of cash? So that's really the whole complete cash budget. This just had us do the receipts only.